So the stock market YouTuber narrative of not financial advice usually goes something like this. Buy a low-cost S&P 500 index fund, hold it for 30 years, dollar cost average over time, and before you know it, you'll retire a multi-millionaire. It sounds like a pretty straightforward investment strategy, and even one that Warren Buffett advised during his CNBC interview back in 2018.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore.
But is this still sound investment advice in the ever-changing macroeconomic environment? Well, don't get me wrong, I'm certainly not challenging the wisdom of the likes of Warren Buffett, because he sure as hell knows a hell of a lot more about investing than I ever will. But you do have to consider that the economic conditions and the stock market conditions are very different now than they were back in 1942. Unprecedented quantitative easing, a global pandemic, inflation at 40-year highs, asset prices at historical highs, and threats of war between Russia and Ukraine. These are without doubt very unique market conditions that not many investors have probably faced into before, and certainly not all at the same time. So let's talk about whether the S&P 500 still holds up as a good long-term investment for me and for you guys in order to help us achieve an average annualized rate of return of 9% per year. So I'm going to break this video down into two parts, and in part one we're going to talk about the potential for a lost decade of returns, because a decade of lost returns is certainly something that I'm becoming more mindful of. It's a pretty bold statement to make, so let me explain it in a little bit more detail based on the research which I've done and some of the parallels in which I've drawn from some of the historic events that have happened in the past. So the first consideration, the S&P 500 hit an absolute peak of 4,796 points on January 3rd, 2022, which at the time resulted in an inflationary adjusted price to earnings ratio of about 37. Now, of course, asset bubbles have happened in the past, and as a result, we can look back at some of the inflationary adjusted price to earnings ratios which we've seen before. For example, the dot-com bubble, before that burst, we had a price to earnings ratio of nearly 45, upon which point the stock market did go on to crash somewhere in the region of about 45%.
I am never going to financially recover from this.
So whilst we're not quite at the levels of euphoria that we saw back in the dot-com bubble, we're not exactly a million miles away today, and as a result, the S&P 500 could eventually have the same fate, crash down in value in order to get stock market prices to somewhat more of a fair value. The reason why I call this out is because when the dot-com bubble crashed, well, that did quite literally result in a decade of lost returns. In actual fact, it took roughly about 13 years for the stock market to actually recover. But the one notable difference here is the economic conditions which we're facing into. As we all know, back in the late 90s and the early 2000s, there was this big tech euphoria. People were piling into tech stocks, and as a result, asset prices went absolutely through the roof.
AOL, Yahoo, Amazon.
eToys has really created a very strong brand awareness.
In fact, it looks like to hit 1 billion shares today.
Internet stocks drove a powerful surge on Wall Street today.
A lot of it was driven due to pure speculation within the market, whereas the current market conditions in which we're facing into today are as a result of extreme fiscal stimulus, which we've seen from the Federal Reserve and the Bank of England over the course of, well, the past 2 years. Every central bank, but more specifically Jerome Powell over at the Federal Reserve, has been cranking that money printer as much as he possibly can, and as a result, the Fed's balance sheet and the overall money supply is absolutely sky high. But all of that eventually comes at a cost, which we're now all slowly starting to find out about as I go down to Asda to do my weekly shop, and it becomes more and more expensive each week. So we obviously have the economic concoction of extreme fiscal stimulus, which has now led on to higher levels of inflation, which I do want to take a listen to what Charlie Munger had to say about this during his annual meeting for the Daily Journal.
We've done something pretty extreme, and we don't know how bad the troubles will be, whether we're going to be like Japan or something a lot worse. And what makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble.
So Munger references Japan, and I can only assume that this relates to what happened to the Japanese stock market back in the kind of late 80s and early 90s. Now, for those of you guys who have absolutely no idea what happened to the Japanese stock market during that period, well, let me give you a very brief Investopedia history lesson. It says Japan's central bank, the Bank of Japan, had pursued decades of unconventional monetary policy. Starting back in the late 1980s, the Bank of Japan has deployed strict Keynesian policy, which is just some kind of fancy macroeconomic term, including more than 15 years of quantitative easing, or the buying of private assets to recapitalize businesses and prop up prices. Sounds pretty familiar. But despite these efforts, there is strong evidence that Japan's easy money policies only produced illusionary growth whilst failing to improve the fundamentals of a stagnant economy. The more Japan's leaders tried to stimulate their country's economy, the less it responded. So in English, Japan printed a hell of a lot of money, similar to how we've seen the Federal Reserve do it, and as a result it pumped up asset prices to, well, unsustainable levels in order to help prop up the economy, which then led on to high levels of inflation. Now, back in the late 80s and early 90s, inflation in Japan did only hit highs of just shy of 5%, but that was enough for the Bank of Japan to actually tighten their monetary policy. Again, similar to how the Federal Reserve are doing things right now, they actually went on to hike the official discount rate from 2.5% to 4.25% by late December 1989. Then in 1990, Japan hiked rates again to 6%, which then inevitably resulted in a 35% market crash.
I declare bankruptcy!
This would then be the start of 3 decades of lost investor returns for the Japanese stock market, because quite literally between January 1991 and November 2020, the Nikkei returned just 1% to investors. Quite literally 30 years of lost investor returns as a result of poor management of monetary policy, resulting in extreme asset bubbles. I really do hate to say it, but all of this kind of economic condition sounds all too familiar, and I kind of feel like reading between the lines, Charlie Munger's kind of got the same thing on his mind as well.
There's never been anything quite like what we're doing now, and we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble.
Now look, I do want to point this out. I'm not just sharing this just for the purpose of fear-mongering like so many other YouTube channels do. Instead, I'm just sharing what some of my personal considerations have been from just some of the research in which I've been doing recently and the interviews that I've been watching from the likes of Charlie Munger, who has a hell of a lot more investing knowledge than I ever will do. But I'm interested to get the opinion from you guys. I think we've all kind of come to the conclusion that asset prices can't stay at these kind of historically high sustained levels for any prolonged period of time. We've already seen the decline in growth stocks, which have certainly been the first casualty based on current investor sentiment. The next question is whether that will actually translate into stock market prices anytime soon. The S&P 500 is basically in a correction already, so will this be a kind of prolonged period of market prices slowly declining over time, or will kind of market forces and broader macroeconomic conditions magically correct themselves and push things back in the upside direction? Be sure to let me know what your thoughts are down in the comment section below. But with that all in mind and very much the doomsday scenario presented, what are our other options? So now let's talk about part 2, which are the other investment choices in which both me and you guys have. But before we talk about that, let's firstly just consider the risks at a high level. We all certainly have the risk of historically high market prices, which certainly result in the US stock market more specifically certainly being less attractive to investors during this time. The other obvious risk that we also have is high levels of inflation, with the US seeing 7.5% rates of inflation, and in the UK we're at about 5.5%. To give this some context, if you're over in the United States, well, you will lose half of your wealth at this rate of inflation in just over 7 years. But if you're over here in the UK, then we'll lose just over half of our wealth in just over 9 years. So holding money in cash isn't really an option either. So I guess the remaining feasible options which we have on the table, I guess you could say, are real estate, value stocks, or some kind of other index fund, along with cryptocurrency too. So real estate first and foremost certainly seems like a sensible option. Just thinking about this more logically speaking, if you borrow a set amount of money to mortgage a property at, let's say, 3%, and inflation is currently, well, 5.5% over here in the UK, then you're benefiting straight away just from the arbitrage of this investment. Plus, you only need to take a very quick look at wage and house price disparity over the course of the past 2 or 3 decades to realize that houses are a pretty good investment investment over time. Then if you add a renter to the mix to pay back the mortgage on your behalf, not only does it provide you with an income, but you're also benefiting from the capital gains on the property as well.
Tell them to bring me my money.
Now, of course, investing into property certainly has its risks associated with it, but in my opinion anyway, it's a lower risk way to actually diversify your investment portfolio beyond that of just solely investing into stocks. This is something that I'm personally seriously looking at right now, and hopefully over the course of the next couple of months I'll have some good news which I'll be able to share with you guys on this channel, but more on that in another video. The second option, of course, is value stocks, or buying into indexes that trade at a lower premium than that of the S&P 500. We've already seen the transition into value stocks over the course of the past few months, and even into 2021 as the stock market reached a peak. Energy, real estate and financials were the top performers, and it's been the first time in many years since any of those sectors top the charts in terms of returns. So clearly looking into companies which have strong balance sheets that trade at a fair value look like certainly the far more appealing play for investors in these current market conditions. Then the third and final option is cryptocurrency, and whilst it's an option, I'm certainly not saying whether it's a good or a bad option, because as we all know, cryptocurrency is very much up in the air and no one truly knows where it's going to go in the future. Will the likes of Bitcoin be the ultimate hedge against inflation, as so many people talk about, and will some of the big companies join Tesla in holding some Bitcoin on their balance sheet because their dollars are losing so much value? It's certainly hard to say, but it's certainly an option that I'm open to in terms of allocating a small portion of my investment portfolio to some more speculative assets during these current market conditions. Because for me, the small allocation within my investment portfolio is certainly worthwhile the risk on the basis of the potential upside which we have on the cards versus the potential loss which I could face. It's of course a high risk, high reward play, but certainly a risk which I'm prepared to take. But what are you guys doing with your investments right now in this current macroeconomic environment? Be sure to let me know down in the comment section below. Are you guys looking to buy the dip on your existing holdings, or are you looking to diversify elsewhere? So they are all of the considerations which I currently have on my mind right now, which I wanted to share with you guys. And with that said, if you do want to learn a little bit more about how to create the perfect investment portfolio, be sure to click on this video here. Drop a like on this video, guys, if you did enjoy it. Subscribe to the channel if you're new around here. And with that being said, see you over in the next video.